I'm thrilled to have hundreds of you participating in this webinar this morning, and I want to thank you. With me today is Professor Ed Altman, and Dr. Altman is the Max Heine Professor of Finance at the Stern Business School, and he is also the Dean of the MBA program, or chaired the MBA program. He has an international reputation as an expert in bankruptcy, high-yield bonds, credit analysis, and primary areas of research were in bankruptcy, in analysis, prediction, credit, lending. Just a great resume that we just had tried to narrow down. I'm Jerry Flum. I'm the CEO of CreditRiskMonitor. Before I got to CreditRiskMonitor in '99, I spent some time, 30 or 40 years in the investment business. And let's move on to these questions because we've got time to go.
Jerry, I'm delighted to be with you today and really pleased to be speaking to so many dedicated credit professionals.
Thank you, Ed. It's my pleasure also to be with you. Well, just some ground rules. The ground rules are we're going to have 40 minutes of discussion, and then Ed and I are going to have 20 minutes of Q&A, and we'll try and answer all the questions. If not, we'll try and answer them after the WebEx. Let me show you what we started with to get this thing going. This is our first chart, and it's my chart really more, and I think it's an important chart, and the thing is this is debt as a percentage of GDP. And I want you to take a look at the top in 29. I want you to take a look at 207. And what you can see here is that debt's growing very, very quickly. And when debt grows quickly, it leaves a lot of leverage into the system. Right now, we have 3.5 times of debt times GDP. So the important thing, or one of the takeaways here, is somebody owns that debt. There are investors, it's in pension programs, it's in 401ks. So as we look at it, it's companies getting in trouble and the people who own that paper. Now, this next chart is just an indication to show how quickly or how much debt is coming into the system. What this is it shows every decade. The first decade is 1949 to 1959. It took about $1.37 of incremental GDP in that 10-year period to produce $1's worth of GDP. And as we slip in, as you can see, 1979 to 89, it bounced back up to $2.95. And then in 99 through 2009, the last one, it's up near $6. So obviously there's a huge amount of debt coming in to drive that GDP. This is a chart that I put in. It's just a quickie. The U.S. is on the bottom, and what it shows is our debt to GDP, which was extraordinarily high. But as you can see, this is a problem all over the world. In fact, it's much worse all over the world. Those are different countries that you should take a look at, or areas. So there's a huge amount of debt, Ed, and it's an unprecedented problem, and it's never really been seen at this level before. And the riskiest part of it is going to be junk bonds and possibly junk loans. So this is your area of real expertise. So why don't you tell us what you think?
Well, thank you, Jerry. Certainly the high-yield bond market, the leveraged loan market, is the front runner where the possible problems could manifest going forward. As you can see, the growth in that market has been dramatic. We're about $1.6 trillion in the US today, about $550 billion US in Europe. And if you combine all the junk bonds in the world, we're talking about $2.5 to $3 trillion, the highest it's ever been. And of course, there's been a huge growth, mainly because investors are searching for yield. And when investors search for yield, it's risk on. And we've been in a benign cycle, which we'll talk about later, for a long time, and people let their guard down when things are going so well. And we are here today to talk about the fact that you should not let your guard down, given the fact that things are so good, and look about what could happen. And your point about the amount of debt buildup in the world is right on. It has built up. But let me also show another graph, which I think is really important.
This is a great chart.
It's one thing to talk about macroeconomic data. I've never been a macro fan to predict financial distress unless you can combine it with a lot of what's going on at the grassroots level, at the firm level in each in every economy. So this graph shows the peaks in the non-financial corporate debt to GDP ratio, something like you were talking about before, at record high levels. And if you look at every peak that's taken place back in the early 90s, again in the early 2000s, again in 2007, 2008, you see that very soon after that peak in non-financial corporate debt to GDP, you have a tremendous spike in default rates at the grassroots level. It happened in every cycle in the past. Now we are again at that peak level of around 45% debt to GDP, non-financial debt to GDP, and we are not at that level with respect to default rates. However, if history repeats itself, those default rates could spike quite a bit in the future because of this debt buildup. And I think this slide is a very important one that combines the macro that you were talking about and the micro that I have over the years focused on. Another thing to talk about, since this is your slide actually, but let me piggyback on your slide because some of them are pretty terrific. And some of them are ones that I think you can talk about better than I can. Look, corporate debt issuance, we all know, is going through the roof. Companies are taking advantage of low interest rates. Companies are saying this is the time to lever up. And we'll talk about their ability to lever down in the future, which has been compromised dramatically, as we will show you. At the same time, equity issuance has gone, net equity has gone in opposite direction. So the debt equity ratio, whether you're measured in book value or market value terms, is way out of line to what's happened in the past, except when we've had a crisis in the past, when it was also very high. So this is a very good slide. Thank you very much for that.
Thank you. I would like to add one other thing here. This chart is an indication that it's really good for the investor community because they're getting bought out and corporations are raising debt, taking the cash in, and then increasing their debt and paying the cash out by buying back stock and paying dividends. They're not building plant and equipment. They're not hiring people or training people. So all of this is good for investors and pretty terrible for trade creditors, pretty terrible for purchasing managers, and pretty terrible for lenders. So basically, the lending class is really going to be in real trouble.
Yeah. This is a slide I have to do with Europe, but it just shows how out of sync the interest rates are. For many years, the European high-yield bond nominal interest rate and the spreads were about 100 basis points higher than the U.S. Now it's just the reverse, that the spreads in Europe are much lower. Of course, their benchmark rates are lower, but investors are taking enormous risks for relatively small amounts of yield, but many people think it's the only game in town, so risk on. So we got to be careful about that going forward too.
Well, I think that's a perfect picture of a mania.
Well, mania, it certainly is something that we've been living with, these negative interest rates for a long time. And this chart is yours as well.
Yeah,
what does it say?
This chart for me is, it's a Warren Buffett favorite. And you can see in 1929, the market value compared to GDP, and then you can see how that led to a crash. And now in 2000, it popped up really high, and then in 2007, now it's even higher. And this is important because this equity cushion, for some reason, allows some of the junk bond investors to believe that these corporations will be able to sell some stock in the equity market and buttress up the junk bonds.
They can do it right now.
Yes.
But when things turn,
wow,
it probably is going to be too late. And this is very important.
Yep.
Timing and what used to be in the past. Let me show you a follow-up to this one that I think might be quite relevant.
Okay.
As you know, I've been playing around with something called the Z-score model for about 1,000 years, but actually it's been 50 years, and it's just about 50 right now. And we're happy to celebrate that anniversary. Back in 2007, the average Z-score of U.S. corporations, and particularly high yield, were at relatively low levels, but right before the crisis. Today, the high yield bond Z-score is actually at a slightly lower level than it was in 2007, And so I don't think that's very good news for the fundamentals of companies. The probability of default of companies today, based on fundamentals, not based on market yields, is at a pretty high level. And one of the variables in the model, which some of your viewers hopefully will remember, is the market value of equity to total liability ratio. In '07, it was around 3 times. In other words, market value of equity was 3 times debt. Today, it's about 1.5 times. And you may say that's strange because the stock market has been buoyant, and it has been. But what is not as clear to people unless they look at this ratio clearly is the fact that total liabilities of companies have grown astronomically, and the ratio of equity to debt has actually come down rather than up as most people had thought. So that's very important to remember as a risk indicator. And then finally, with respect to this nexus between stocks and bonds, here's something that not too many people are focusing on. Back in the cycle between 1987 and 2008, 2009, the correlation between stock prices and bond prices was moderate, about 0.4, 0.5 correlation. Since the great financial crisis of 2008, 2009, things have changed dramatically. Now the correlation is over 0.7, which means just about any time you see any news in the market and the stock market reacts positively or negatively, the high yield or risky debt market resonates in exactly the same direction, almost to the same degree, meaning that there's no place to hide anymore. So it used to be that a company could say, okay, we've got too much leverage, it's time to issue debt, equity to take its place. That's no longer going to be the case
that's a big
once
safety valve.
things change. Right now, yes, companies can do it. But if things change, and maybe we'll get to this at the very end, we're going to find things are going to be much more difficult to have this trade-off theory between debt and equity right itself going forward. Again,
Great
it's
point.
a subtle point, but I think an important
No, I think
one.
it's a great point. The flexibility to save themselves or to buttress up their balance sheets is not as present as it was a long time ago.
Yeah.
Great point. Look, the markets for debt have gotten huge, and that's what we're discussing here. And so, as we discussed, it's changing the game for CFOs. So the question that everybody's really asking, Ed, when's this going to really happen?
Yeah,
I want everybody to see Ed's slide. This is not this one, the next one.
well, okay, this is my slide, Grady.
Okay.
So let me show it first,
Okay.
because it has to do with the question of where we are in the credit cycle,
Okay.
and when and if things are going to change. Well, we've been in a benign credit cycle, ladies and gentlemen, now for almost 8 years. Historically, benign cycles, and I'll define it in a second, last at most 7 years. 4 to 7 years has been the cycle. We are now in unprecedented territory with respect to this benign cycle. What is a benign cycle? I define it in 4 variables. Low default rates, high recovery rates if there are defaults,
Right.
low interest rates and yields and spreads, and high liquidity. When you have all of those factors pointing in a benign direction, as we are today, with low interest rates, high recovery rates, low yields and spreads, and high liquidity, all those 4 variables, we clearly are still in a benign cycle. A year or so ago in 2016, we might have said something different as rates were rising, recovery rates were going down, yields are high, and liquidity was low. That's no longer the case, and we can speculate why.
So this kind of allows this kind of thing to get out of hand, really. I mean, when you look at it, it's usually the lows of these things, or the most benign right before the storm.
It's almost a paradox. You are in a situation of a benign situation. Everyone says things are great, let's take advantage of it. Risk on. And when risk is on, you forget about history.
Right.
So let's take a look at spreads.
Yep.
Spreads today on high yield bonds on the right-hand side of this graph are about 400 over treasuries. Historically, it's about 520. and so we're lower. Investors are requiring a lower spread versus treasuries than most times in the past. Again, indication. Default rates. I have an updated figure for you and your viewers. Our default rate year to date on high yield bonds is about 1.4%. Our forecast for the year was 2.5%. Yes, we've had Toys R Us recently. We've had Seadrill in the oil and gas industry that has really picked it up. But we're still in a benign, less than historic average default rate period. So the conclusion is we are in a benign cycle and have been now, except for a little blip up in early 2016, for almost 8 years. Unprecedented.
So that leads to malapportionment or malinvestment, because what's happening is people are able to raise money at such low interest rates, it goes into less productive and less productive and less productive uses.
Well,
so the debt goes up,
yeah.
and we can see it in the amount of dollars it takes to produce a dollar of GDP. It's because that debt that's being added is so inefficient because there's too much of it.
Yeah.
The other thing too, Ed, is that in my mind is somebody owns that debt. In other words, it's in the portfolios, the pension plans, the 401ks, the mutual funds of all of America and all of the world. So if in fact interest rates were to go up and defaults were to go up, the wealth of everybody is going to go down. And right now, you're talking about $2.5 trillion to plus of really high level risky stuff, and we're looking at a default rate of at least 10 to 15%. So we're talking about, I don't know, $300 billion of defaults, and that's going to be.
That's if we have a crisis.
Yes.
Right now, the default rate's much lower, and people are
well,
attuned to what's happening yesterday rather than it happened 10 years ago.
Well, I want to put that in the context of GDP. In other words, if you got that much risk and GDP is only 19 trillion, boy, that's going to an elimination of a huge amount of wealth. People are going to start saving, which has the possibility of meaning huge overcapacity all over the world, because demand will, as people save, the demand or purchasing power or the willingness to purchase will go down. So that's huge overcapacity, which means margin infringement, lay it on top of huge debt at corporations. You know, this is a brew that is going to be very difficult.
Well,
so let me.
Yeah, go ahead.
So let's take a look.
Let's just take the conclusion to this cycle.
Okay.
Recovery rates are very high. 62 cents on the dollar is the average bond, probably for loans that default. It's well over 70 cents on the dollar, historically very high. So again, benign. But in 2016, it was only 30 cents on the dollar, as you can see in the second column there. So it can change very quickly. Our forecasts using a number of techniques show that the default rate is likely to be about 2.5%, 2.6% over the next 12 months. That's below historic average. But, and this is a big but, if we have a catalyst that of course is very difficult to forecast, that default rate could spike quite a bit, especially if certain industries like retail in particular continue to have problems. So the point we want to conclude is that we're in a benign cycle, and don't let your guard down. And I want to come back to that theme at the end.
Okay, well, my point is that we now have the investment market, the debt market, and the equity markets at 4.5 times GDP. And so the portfolio managers who run those markets have this huge amount and a very small exit. And so they may start to anticipate the problems, and if they begin to anticipate and begin to sell, trying to get through that small door is going to be very horrible, and therefore these debt and equity markets will come down, and it will actually eliminate a huge amount of wealth in the part of, when you look at it, it's probably 20
and
or
they
30.
will move together.
Yes, and they're
know
going to
that now.
What a struggle to get
Let
up.
me also point out another thing, and I'm not the only one talking about this. The ETFs out there.
Yep.
There's a lot of people with money in ETFs, high yield ETFs especially, but also ETFs on equities. And ETFs, when there's a down market, need to sell. And if everybody's selling at the same time, you're going to find that liquidity problem creeping in even more than it has in the past. I don't think ETFs are the biggest problem out there, as some people do, and maybe have written about, but I do think it's another factor, talking about
Right.
exiting and going through a narrow door,
Yeah.
that we're concerned that.
I'm just concerned that they're so massive compared to the economy or to the GDP that they will cause changes in the attitudes of consumers out there to buy things, and all of a sudden this thing could spiral quickly out
Yeah.
of control. You know,
Timing is, of course, what we're also
Well,
talking
you know,
about. I
leverage-
don't think it's going to happen tomorrow, but you know, the problem is we let our guard down, and then tomorrow comes very quickly.
I agree.
And
So look, I just thought I'd throw
this
this.
is your chart,
It is
Jerry.
my chart.
What's it
I
say?
put this chart is it's a cute one for me. What it is, it shows leverage in terms of margin. The spikes on the right-hand side are margin as a percent of GDP. And as you can see, not only is every part of our society leveraged up, and the investors are leveraged up, even the college kids are leveraged up. You know, I don't know who's left not to be margined or leveraged up, and here it is right in the stock market.
Well, you know, this points to something even beyond the consumer. We've had a central bank activity in the world focusing on low interest rates, trying to get the level of GDP growth up. It has created this enormous fondness for
Yes,
debt at
unreal.
all levels. And what you're talking about is human nature, taking advantage of situations that are out there now without worrying about the consequences on a time when interest rates will rise, as they inevitably will,
Right.
and also when valuations fall. And we know now they're going to fall together as opposed to separately. So
You know,
very important
you
point.
raised one interesting, not one, but many, but this is another interesting point. As interest rates rise, the existing debt and bond market, the one that's already in existence, is going to contract.
Right.
And as that contracts, because it's 2 to 3 times GDP, it's going to really diminish wealth.
Yeah, I'm worried about that.
And
you know,
it's going
the
to
poor-
be a catastrophe.
us poor folks, especially at retirement age or near that, of course we'll never retire, Jerry, but near that age, have been suffering from low interest rates for a long time.
Right.
You know, where do we put our money? And then we find that when, in fact, the interest rate starts rising, that's also bad.
If
bad
you
news for
already
us
own the
because
instrument,
we own,
it's horrible.
We own the instruments.
Yeah, and so
Yeah.
it's going to impact wealth.
Yeah.
So let's talk about what our audience should do. And I think there's really two things, and I know you have some things for them to do. There's one is that I believe that the debt that's been put into the corporate world is being put in at the public company level, not at the private company level, because public companies can borrow much more easily than private companies. So the risk is more at public companies, which is kind of counterintuitive. And also, public companies are quite large. They represent somewhere around 30 to 40% their revenue of the GDP. So they, you know, they're a small amount of companies, a couple of thousand in the U.S. There's 4,000 or 5,000 of them, but they represent a huge amount. So that risk is at large companies, and as I said, the debt is large there. So they need to build a process here to get in. I think it's very, very important to, when you're dealing with public companies, to look at their balance sheets, P&Ls, exactly the stuff that you look at in the Altman. See,
Fundamentals.
and what we use in our Frisk scores. The second thing is I think that you need to build a process now before the storm hits so that you're comfortable, because if you got to put a process together in the middle of a storm, that's a real hard thing.
Yeah, I agree with that, and I agree with the public firm issue you brought up. But keep in mind, Jerry, that a large amount of American industry are privately held now through the private equity fund process.
Yep.
You know, taking out the public debt and making the firm go private. So those firms have
Yes.
leveraged up dramatically. The valuation of companies that have gone through leveraged buyouts relative to cash flow now is at an all-time high. The PE companies are paying 10, 11 times cash
Wow.
flow for companies. Our financial analysts out there can resonate that that is unprecedented, which means that they have to use more debt to buy these companies.
Well, here's an interesting point here. On our scores, our Frisk scores, we follow debt companies also. So where we do financial analysis.
Private companies.
Yeah, they're private, but they are issuing public debt.
Right.
And so we follow those companies off risk score, which again is using financial instruments as one of the foundations as opposed to just trade receivable data.
Yeah.
And so I'm with you on that. I think it's a huge change in what's going on.
Something else to be concerned with is the fact, again, that high correlation between stock and bond prices.
Yeah.
So if you observe a drop in one or the other, probably in stocks, but it could be even in risky debt first or about the same time, it's time to move, but you may not have the time that you thought you had in the past because of that high correlation. So watch out for falling stock prices as an indication not only of lower growth rates in the future, but also of a big spike in default rates.
Good point.
And stay alert, of course, to a major market correction. Now, that's easy to say, but very difficult to do. But
Yep.
the downturn could happen very fast.
I agree.
And finally, let me maybe a little bit more philosophical point, but it's one that I remember cautioning about in 2007 when we were predicting a major crisis. Don't let down on your credit culture. It's really important that credit culture within an organization stay important and prominent. It's very easy to push it all aside and go for market share. Increase your revenues to the extent that you don't look at the debt ratios. Make sure
Yep.
that the credit people in your organization have an input as to the next step in your growth process. And be very careful about signs that indicate credit is becoming too risky.
I agree. These are good points, Ed. Really good points. So let's open it up to the questions, and you and I will go at them. I've got some questions that came in, and so let me distribute them. Ed, this one's for you.
Okay.
I'll take this one, and I'll give you this one. I'll take.
Thank you very much, by the way, everyone, for sending in questions beforehand.
Well, we'll have to answer some
Trouble
of
is,
them
they're
after.
tough.
Yeah.
Why don't you take the first one, Jerry?
Well, I'm taking, let's see, when the stock market, with the stock market so high, there must be some reason why investors believe that stocks are not overvalued. And what are those reasons? To be honest with you, I can only think of one reason why people would buy stocks at such super high valuations, and that's the potential of a corporate tax cut. You know, that's the real outlying positive out there, and I think it could be helpful, although it's so built into the market. I think if in fact we could get it, being an old hedge fund manager, you know, you buy the rumor, and the reality you want to sell because it's never going to equal the rumor's potential. So that's what I see. What's yours?
Another question is having to do with interest rates in the future and the likelihood that they will rise. Some of you may have read today in the newspaper, Janet Yellen was talking about her perplexing evaluation of what's happening with inflation or the lack thereof. But they're still committed to raise interest rates probably in December for the third time this year. But these are raising interest rates at very low levels. And of course, they want to do this so that if we do go into a downturn, they will have again the interest rate mechanism to try to turn things around. And when rates are very low, as they are now, they wouldn't have that option.
Yeah, that policy option is to protect everybody when this thing starts again is no longer present because the rates are already too low.
And they're not going to. It's not going to be present at the current rates, or even if they raise it a little bit. But here's the anomaly about the possibility of rising interest rates. Every time we see some sort of concern out there, whether it be geopolitical, whether it be fundamental, whether it be economic growth, debt levels that we've been talking about, every time we see that, there's a flight to quality. And what happens when there's a flight to quality? Bond prices go up. I'm talking about government bond prices now, and interest rates go down. So we have not been able to effectively raise interest rates, even if we are concerned with inflation. We're not concerned with inflation now, but they're still talking about doing it. So I'm not convinced that interest rates are going to go up as much as people think they are,
Right.
mainly because of this phenomena of flight to quality.
Yeah, well, look, we have almost $11 trillion of negative sovereign debt been issued, which has never happened in the history of mankind before. Somebody giving a government $1 to get back 98 cents is basically
You mean negative interest
yeah,
rates?
that's a deflationary bet practically. At the end of the day, they're saying just if I can just get my money back, even though you give it back less to me, it means I believe I can buy more goods with that same 98 cents.
Well, let's face it. A lot of the growth that we've had, and it hasn't been that much, has been fueled by debt
Absolutely.
and not productivity. That's the problem. And it's not just in the U.S. Let's take China. There's another question out here
Yes.
about China and its debt level, which
Yeah.
a lot of people are concerned with. But not everyone. I know some experts who are saying, don't worry about China. They can handle their debt problem because it's a centralized government and they really move in the right direction when they need to and very quickly. And they've done that in the past. But here's my concern with China. First of all, China is every bit as important, if not more so, than the United States today in terms of its impact on emerging markets, its impact on companies throughout the world. And that's mainly because of their enormous buying power. Now, Chinese debt to GDP is not even as high as the U.S., but it has grown much faster. It's about 2.5 to 3 times, whereas the U.S. is 3.5 times. But the Chinese debt that is not on the balance sheet, it's off balance sheet, and that is not that easily measured, is what's called shadow banking. Maybe that's a negative term, but that's off balance sheet stuff that is being foisted on the public through wealth management products. That is potentially the Achilles heel
big problem.
for China. And I would watch that level, and I know the government is watching that. At the same time, people really like it because they're getting more than 4 or 5% on their money by moving into these wealth management products. I'm visiting China in about a month. I'll be back and maybe we can talk about this again with perhaps some better insights. But my concern with China is the fact that it's grown so fast of late, and while they have had success in the past of dampening it down when things look like it's getting out of hand, at some time a panic could set in and the government may not be as efficient as they have in the past. So keep your eye on China.
Yeah,
It's a
I
major
agree.
one.
I think it's a big, a potentially big problem. Also, over the last 30 years, most corporations around the world have, for the most part, offset their manufacturing and moved it to China, so that they outsourced the manufacturing side and kept the management functions and finance functions at headquarters.
Yep.
And manufacturing is the most cyclical part of any corporation. It's the longest lead times to change. So the Chinese are disproportionately dependent on the most cyclical part of the corporate world, manufacturing. So it'll be interesting to see how they really get through this, because the flip side of central planning is that yes, you can react, but you're dealing without good signals back from what's going on in the economy. I mean, the knock on central planning is that it doesn't react to issues because it can't read the issues.
Well,
So,
they're pretty good in the past. I mean, you got to give them
Yep,
credit.
I do.
And these were one of the problems back in 2016. We were so concerned is what was going on in China, and somehow or other they dampened it down. And I think that they're going to try. They think that they can do it again. We'll see. But the one thing about China that I've always learned about, whether it's China or any other country with this benign situation for a long time, even think about South Korea back in 1998.
Yep.
We underestimate the problem unless we look at fundamentals. How healthy are the underlying companies in the system? And the Chinese companies, on average, are not that healthy. We read about Alibaba's and the like, but the state-owned enterprises, for the most part, are a big drag on their economy in terms of their health, and that could be an Achilles problem as well.
Huge amount of leverage there. In fact, incremental debt comes in to pay interest. I agree with you. It's an
Maybe
Achilles
we have time for one more.
Yes. Let's see. The next question comes from Sony Electronics. Is the issue with debt limited to publicly held companies, or are privately held companies also at risk? And if private companies are also at risk, is there a difference in how you would monitor those solutions or those situations? And yes, there is. Look, public companies have an advantage of having financials available. You can start your analysis there. Traditionally, most credit analysis on private companies looks at trade receivable payables or trade receivables or trade payables to see if a company's paying its bills. And that's a great way to look if you don't have financials. If you have financials, you want to at least use them. And so in private companies, that's really not available. So we look at them very differently. We're also starting a new service at Credit Risk Monitor. Interesting, coming out in the first quarter of 2018. We're going to have a system that we're putting in place to allow our subscriber base to get confidential private financials, and we will input them into a database. And from there, we can do financial analysis, and we can compare the metrics or peer review those companies against our whole database of public companies.
Well,
so that's a huge step forward.
Yeah, it's very important. In the financial world, especially of late, what I've observed, the importance of data. And there have been some great valuations and some great sales of data companies to big established financial companies at astronomical rates, mainly because of the power of data. So yeah, I applaud your new service in that respect. Let me say one more thing about private versus public companies.
Yes.
And the importance of small and medium-sized firms as well as public firms. And we're doing a lot of work in Europe now on making it available, financing available for the small and medium-sized firms. So if you have any viewers out there that are interested in SMEs as opposed to the big public companies, let me hear from you, and we'll be happy to tell you what we're doing to build models to monitor the health of SMEs. But I agree with you.
Cool.
When it comes to the big picture of the economy and potential crises, it's the public companies or the big companies that have been taken private through the private equity market, and we need to monitor them as well. We have models both for public and private companies, as you do, and I think that's going to be very important.
Yeah,
for
I
ours.
agree. I think not using good modeling now and using all available data and restricting yourself to small subcategories of data is just not a smart game anymore.
Yeah. How are we doing on time? Well, I think we still have a little bit more time.
Oh, we do? Oh,
Yeah.
great.
Yeah, we do. I have one more question here.
Okay.
And it's about, despite refinancing efforts, it says large quantities of debt are scheduled to mature in the next few years. How will rising interest rates affect refinancings? Well, let me make two comments on that. You hear about this maturity cycle as an important indicator of potential distress. The argument goes, if you have a lot of debt maturing in a short period of time and companies have a problem in refinancing, you're going to see a big spike in default rates. And I don't say that that's untrue, but what we found is that companies do not necessarily default that much when new debt is, when the old debt is maturing. Companies fail when their cash flows are not available to cover their interest burden and other expenses. And the maturity level is a factor, but not a critical factor in the default cycle. And I can show a lot of data to that effect.
That might be influenced this time around because, one, these junk bonds that are going to be refinanced were issued at very low rates. And if, in fact, the rates stay the same, then you're right. You can just go out into the marketplace and refinance. If, however, the rates are up reasonably dramatically in the whole world because of the central banks trying to raise the rates, and in addition, the higher rates needed to compensate for more risk, all of a sudden that cash flow that you're talking about is going to get terribly impacted by the need to have a huge amount of incremental debt coming through that P&L.
Yeah. Well, I know the argument, Jerry, and I've heard it. Higher interest rates are going to impact firms for many reasons in a negative direction. I'm not, first of all, convinced that interest rates are going to go up that quickly for the reasons I mentioned before. And I frankly think that the maturity cycle is oversold. What really is important are the fundamentals on cash flow versus interest rates. If we have, of course, a crisis situation and interest rates are high, companies need to refinance. Then clearly you're going to have problems. But what I'm concerned more are the fundamentals. And one further thing about the maturity cycle. In the bond market, we're not facing a big increase in refinancings until 2020. It's not happening in 18 or even 19 that much. It's really a couple of years out because firms have been successful in pushing the problem down the road. So I'm not too concerned with it in the next year or two, or maybe the third year we have that issue. And of course, predicting what's going to happen in 3 years is really tough. So I don't think this maturity cycle is really a key factor. I do think interest rates are a factor, and I wish I was better at forecasting interest rates, but I'm not. I don't think anybody is really good.
I agree.
Because look at those folks that have been forecasting rising interest rates for the last couple of years. They've been dead wrong. If you've been short, you know, the old black swan approach, you've gotten killed. I think it's very dangerous to bet your farm on the interest rate or the currency level thing. Really concentrate on fundamentals. That's been always my mantra for so many years.
Look, Ed, it's hard to argue against the looking at an individual company or companies and see how they're functioning on profitability balance sheets. But when you're talking about debt markets and equity markets, 4.5 times GDP, the guys who are running all that huge amount of money are using indexes and are using the way to, how do you invest this much money? And so they're going to head for the exits at the sign of macro stuff also, because they're not involved in individual selectivity. And as they sell out and as they try and get ahead of the curve, they're going to drop the value of those pieces of paper, and it's going to be in the pension funds, it's going to be in the 401ks. People are going to get their statements from Fidelity. They're going to think they're worth $50,000. They're going to wake up and find out they're worth $10,000. And so it has a huge impact on their willingness to buy things. And so it's the demand side of the curve. The supply side, there's so much money floating out there, people can't even put it in right now to the supply side. So they're buying stock back. That's what corporations are doing. There's no eternal use for the capital. So what happens now is that demand for goods could be seriously overstated if in fact markets start to collapse. So what I see is it's the portfolio managers in the equity and debt markets now who are disproportionately powerful, and they look at different things. They don't look at the same stuff we do in operations.
Yeah.
They're looking at a different set of numbers. They're going to look at, is the moving average of stocks going down over a 12-month average, over the 24-month average? Is, debt prices increasing the speed of descent? These are all indicators that they have to look at, and we don't.
Yeah. Well, all of this, I think, puts a greater emphasis on being aware of the situation and not be overwhelmed by this benign, low volatility market that we've been in. I mean, I'm scratching my head, as Janet Yellen is, about inflation with respect to volatility. I don't understand it. I don't think anybody can explain this low volatility, except if you use what I like to call deferred volatility. What's happened out here, I think, is everybody seems to be so concerned with it that they're doing what they can to defer it. And the problem is, like exiting through the door, and the door is narrow with respect to equity markets or even risky debt markets, we have the same potential problem with respect to this issue of credit culture. Let's not worry about it now, it's saying, because things are so good. I remember I was giving a talk in Malaysia long time ago. It was in 2006, I think it was. And they wanted to talk about Basel II, and they wanted to talk about opportunities in the world. And so they said, what do you want to talk about? I said, I want to talk about credit culture, and don't let your guard down.
Right.
And then, of course, 2007, everyone was worried about the fact that things have been so overblown, as many people are saying now, but they didn't have the courage to get off the speeding train as it was going down the track. and the party was on, everybody was dancing, to use that phrase, and it took more courage to get off than to stay on. I think there's a lot of that that's going on today.
I
it
agree.
takes more courage to
Yep.
get out than it does to stay on. I would definitely say look at hedges right now, that more so than before because of that. But it's very difficult to get off the train. And listen, a lot of people are not paid to get off the train. They're paid to stay on the
You
train.
know, that's a great point. In our service, we have really terrific scores like you do. We have a FRISK score that's 96, 97% effective. But what we also have in our services, we also show all the financial spreads, because we know that the credit manager is a very, very difficult position. It's not only recognizing risk, it's then having to go into that corporation
Yeah.
and sell it that, hey, to the VP of sales or to the CFO, like, this is really a problem. And so you need to walk into the room.
The
with
risk
all this.
management aspect
is a
tough
credit
thing.
managers
It
have
was
a
before.
horribly hard job.
It was before. I think these are great questions, Jerry. Thank you very much for inviting me here today.
pleasure to
I
have
hope
you.
I hope by our banter back and forth, we've been able to spread some decent
Yes,
ideas.
yes. I enjoyed this. This is, for me, very educational.
Thank you, Jerry.
I like
and
being around you.
Thanks very much. Bye-bye.
Bye-bye, everybody. Very nice. You saved me.